In this case study, we are going to look at an interesting situation where an individual wants to pay a lot of money into a high cash value life insurance policy, but his goal is to back into the funding, meaning he wants to see how much do I need to pay into the policy so in 10 to 15 years from now, I can generate X amount of dollars in income. Meaning I want this much income, I want it to be tax-free, that's why I like the idea of a cash value life insurance policy, but how much do I need to pay in? Meaning, Mr. Agent, you tell me how much I need to pay in. Oh, but I want to see it based off the guarantees, a conservative number, a conservative dividend rate, and you can run something aggressive as well, but I'd like to see the conservative figures, not just the best looking numbers. That is the key right there, that so many times, whenever we're looking at income situations, have you ever been told, oh, don't look at the guarantees, or not even shown, it's very unrealistic, but from an expectation standpoint, we know if based off the guarantees or a conservative dividend, if that meets our expectations or satisfies our goals, does what we need, then in a worst case scenario, we're good. We don't have to worry about it. If we bank off of the best case scenario numbers and then it doesn't deliver that, now all of a sudden we're in a situation where we're like, oh, now I've got to make a pivot. I've got to get income from another source. It's just not working out how I anticipated. We have buyer's remorse. That's not what we want. So what we're going to look at in this case, age 55 male. Funding scenario we're going to look at. We're going to back into it. So what he wants to see is as follows: income starting at age 65 and then also at age 70. So different options. And with that income, the request was as follows. As we had the conversation with this individual was, hey, I'd like to see $125,000 per year in income through age 95, but $125,000 today. When I start the income in 10 or 15 years from now, I want to account for inflation. So the inflation factor he wanted to use was 3%. So in this solve, that means, okay, when we put the policy together, I don't need to solve, or I can't solve just for $125,000 of income coming out in after 10 years or after 15 years. I've got to solve for $125,000 plus 3% inflation at that point in time, and a level income stream. We did not look at increasing income over time each year that he took income out. We could do that, but we didn't do that in this sample. So what we did in this case study as we worked these numbers up, and this was kind of the conversation as well, because his goal was, hey, 10 years from now, I want to be here. Here's the level I want to hit. I like what I see with life insurance. I get it, simple, straightforward, tax-free income, don't have to worry about any market fluctuation. I want the income here. So instead of just running this, we said, all right, well, let's run scenarios based off of the present dividend rate, guaranteed rate, starting income at age 65, age 70, different products, and give you kind of a flavor of how much you would need to put in ballpark. Numbers can be adjusted very easily, but a ballpark figure as a starting point, this way we can start to narrow down to the different companies, products, and really understand what we're getting into, and not buy a product that looks good on paper and then find out after the fact, I shouldn't have done this because it didn't perform how I thought it would. So the funding we're going to look at here, as far as how much going into the policy, because this is important, is going to be $300,000 per year for 10 years. So in the examples we're going to look at is income beginning after 10 years at age 65, so year 11, and then also one at age 70. So we're going to fund the policy, let it sit and grow for 5 years, and then see what it looks like on an income distribution, and look at the guarantees, non-guarantees, all that good stuff. So before we look at the numbers, here are some of his goals. He may not maximize the income distribution here, but here's what he wants to look at. How he's going to fund the policy first and foremost, because this is important. He has healthy income, but really transferring assets. He has assets in other accounts, be it tax deferred, taxable. He's big into real estate syndication. He says, okay, I've got some assets here. I'm going to shift money from the taxable accounts over to the life insurance product because A, cash value is safe, liquid, tax-free. That tax-free benefit is huge. But B, from an estate planning standpoint as well, just call it legacy planning, which we don't have here. That death benefit is paid completely income tax-free. So he may elect not to take income from the policy, just let this puppy grow over time, this policy grow over time, and then that death benefit's paid out completely income tax-free. Retirement income, that's his primary goal. What we're going to look at in this case study, safe, liquid, tax-free area to position money, real estate purchases. So we mentioned he is into real estate syndication deals, so he wants that money liquid in his policy. If an opportunity pops up, whether it's a real estate syndication deal or if it's a single family or something he's going to do on the side, he wants the liquidity there. Very, very important. That is a huge attraction point to cash value life insurance as well. So on the design here, right, so if I'm paying in 300 grand per year, we better make sure that this policy is designed properly, because if it's not, the performance will be hindered over time, which will also hinder the retirement income. So very important. On these policy options, you're going to see a premium as low as about 9%. Some examples with some companies will be a bit higher, but the lowest we were able to drive it was about 9%. And then everything else plowing into PUAs in order to optimize the cash value of a life insurance policy. So let's get into it here. This is going to be fun. First thing is first, what do we have here? A lot of options we've got. So anytime we look at a policy when we're looking at income solutions, what we do not want to do is just jump straight to the income solutions. We can, if you're working with us, we'll definitely show you that. You're going to see it in this example. But if you are shopping right now and perhaps you have a local agent or someone you're working with, very, very important to study the growth samples first. A, you can compare the growth sample to the income sample side by side to see exactly how distributing income from a life insurance policy will impact your money, cash value, and death benefits. But then two, when we are aiming to maximize cash value, seeing just the growth models and the full illustrations, if you'd like to see those from the insurance carrier, we do have those available in our membership program on our YouTube channel. You can subscribe to that or become a member there, where we go through some of the detailed illustrations. But we want to see a breakdown there to see if that policy is set up properly and designed for maximum cash value. Because if it's not, when we look at the guarantees, if a policy is not optimized, it's not going to perform at the highest level, especially if we like seeing things from a very, very conservative standpoint. So, two companies here. Company A, we ran one product. Company B, we ran two products. What we see here is Company A. On the left, guaranteed values based off of the guaranteed rate of 4%, their dividend rate of 5.65% for 2021, and then their indexed feature as well, which is a good option, 5.88%. So the nice thing about this, because the individual requested to see guarantees, current dividend rate, the indexed feature is attractive, not sure if I'll use it or not, but I might want to attach it just to have it available as the years pass. Seeing everything up front, having that transparency instead of just hearing, yeah, it's good, or yeah, all guarantees are the same. They're not. When you look at different companies and policy designs, they might have a guaranteed rate that's the same, but the guaranteed values are rarely the same because different companies have different limitations as far as how you can design a policy, how low we can go with the base premium, how term riders are constructed, how aggressive we can go with PUA payments and such, meaning how aggressive we can optimize the cash value. That's the main question there, or the main point. So what we're going to look at, Company A, one product, break-even point in a worst case scenario environment. Guarantees and assuming the term cost, rider fees, everything are charged at the absolute maximum allowable. We cannot make this example look any worse. Break-even point between years 7 and 8. On the guarantees, there's times we work with individuals that see policies based on the non-guarantees, not breaking even between years 9 and 11. And that doesn't have much to do with the company selection. These are with 2 of the 4 major mutuals here. But the reason we would see a policy based off the non-guarantees break even so much later than that, 100% the policy design. We've got a higher base premium, or we have a health issue and have a table rating or something like that. But typically it's the policy design. This is strong for a 10-year fund for a 55-year-old male, breaking even between years 7 and 8. By year 10, he's paid in $3 million. He's got a little over $3.1 million. Death benefit 7.5. Nothing goes into the policy thereafter. He has the option to, but he does not want to pay more than 10 years. Explicitly states 10 years is how long I want to fund it. I've got assets, I'm moving from one area to this. Yeah, if something happens and I want to keep paying, yeah, keep the option open, which we always do, but not obligated, and we designed this to stop payments in 10 years per his request. Everyone's different as far as how long we'd like to fund the policy. Some of us know up front, hey, this is my plan, so we want to build it according to that. Cash value continues to grow quite nicely thereafter with no payments. We executed what's called a reduced paid up option here. Dividend values break even between years 4 and 5, and then the indexed feature, year 4. We've paid in 1.2, we have 1.2. Now also, this company, he can easily commit to a $30,000 premium, meaning he can pay that one time per year, and then 100% at his leisure, he can add up to $300,000. But again, he is not in any way, shape, or form committed to $300,000. Meaning, if you like the idea of putting $300,000 per year into a safe, liquid, tax-free life insurance policy, but you don't want to get a bill for $300,000 per year, you don't have to do that. You can have it where it's very flexible, not committed to doing so. You can add funds at leisure, which is exactly how this is set up. Company B, 2 product options, did not run the guarantees with this report. Traditional policy, Legacy 100, meaning we can pay into it, premiums are payable through age 100, but stopping the funding after 10 years. Because again, he stated, 10 years I want to stop. Breaking even between 5 and 6. And then we have a limited pay product, which upfront is not that attractive, especially compared to all of the other options. Break even between years 7 and 8. Long term, we've got some strong cash value. So if we look at this, same company here, the traditional product, you've got 6.1 million. And this limited pay product, you've got 7.2 million. Same company, same dividend rate, same individual health rating, all that good stuff. The difference here with this limited pay product is how the company structures it. They made a pivot since COVID hit, is during the funding period, you can pay into it for a maximum of 12 years. They actually hold some of the funds in escrow because we're in a very low interest rate environment. So after the funding period, they apply a higher crediting rate to the product. That's non-guaranteed, however. So when we see strong illustrations like this from a reputable carrier, the initial reaction is, wow, I like that. However, I don't really like to purchase a policy or sell off of the non-guaranteed dividend, the potential. Looking at actual historical performance, I do like to look at the guarantees as well. You'll see the guarantees will be, with these designs here, stronger with this guy because you could drive that premium lower. Those are the kind of items we like to analyze up front and just to make sure expectations are set properly, because this wow factor is great and it could very well happen. However, if it doesn't, because it's all non-guaranteed and we're forecasting way out, that's where if I pick it solely based off of that long-term performance and sacrifice the upfront cash value, and then it doesn't come true, If I'm the consumer, I'm going to be somewhat upset with that. It's like, okay, I was sold with the expectations of this great long-term performance. That's why I took the upfront hit, but then it didn't come true. That's what we don't want. No one wants that kind of stuff. This does pay higher compensation. So if you're an agent and you know what this is, you probably think I'm nuts because we're talking ourselves out of that. But again, it's not about the compensation to agents. This is my motto in business, is if you do the right thing, treat others how you want to be treated, show the different options, show the optimized policies, cash value, death benefit, flexibility, everything, so there's full transparency. The individual you're working with will select the option they're most comfortable with. We don't have to sell them or push them in one direction, just show them, and it'll all work out for everyone. It will. The money comes if you just do the right thing naturally. So we've got the different options here via growth. Let's look at some income. So here's I'm talking a lot, big build up to what he wanted to see, income. Let's look at worst case scenario first. Guaranteed values, company A, income. On the left, growth. There we go. Same break-even point we saw before, years 7 and 8. 3.1 million. By year 10, I've paid in 3 million. Now, we're going to look at two income options. He's going to take income from 65 and then 70 through age 95. Okay. Now, based off the guarantees, we can somewhat drain these because it's not going to get any worse than this, meaning it can't. So beginning at age 65, we're able to take $130,000 out. We are withdrawing up to our cost basis first. So first we are withdrawing $3 million because that's the total amount we've paid in. And then we're beginning to loan out the rest without paying anything back. Now, keep that in mind. You'll see why here. So we've got $130,000 per year coming out up until age 95 per his request. This individual actually has a lot of experience in the insurance industry and requested that age 95. Here's what I want to highlight here. So we ran income coming out to 95. What happens 96, 97, 98? What's happening to your cash value and death benefit? It's going down. The reason for that is we have an outstanding loan here. The loan interest, based off of a very large loan balance here, is exceeding the interest earned on a policy. This will happen, especially in today's dividend rate environment with almost all whole life carriers. If you take excessive loans from a life insurance policy, that loan interest that builds up over time, if we're not paying any of it back, will exceed the interest earned on a policy. A lot of times we hear a wash effect. When you look at the net internal rate of return on a policy, that's not always the case. Sometimes on an annual basis, but we got to see it up front. There's a lot of variables that can skew it where it's not in our favor. And it can still be a great place to position money, but if we think we're getting a wash or free loan, if we've ever heard that, we want to know up front, hey, that's probably not the case. This is why my cash value is decreasing here. We've got other videos where we go into full detail on loans and how loan interest works. Now, we time this where even if he died at 105, 110, it didn't completely implode, so he's got enough cash value in there where it sustains. Very important to make sure we're in that position. If we delay the income for 5 years, start at age 70, now we're able to pull out $162 per year. Left a little bit of juice in the orange because I wanted to make sure the policy didn't lapse, so we could pull out a bit more. We solve for the max, and then I undershoot it a little bit. But I mean, with all this said, these are, again, guarantees. So his goal was to do what? Take out $125,000 per year in income, but $125,000 today, 10 years down the road or 15 years down the road with accounting for inflation. So based off of the guarantees, absolute worst case scenario, has always done better than that. what do we see? More than 125, we've got to account for inflation as well. If we go simple, 3%, if we don't compound it, that'd be what? Another 3% on over 10 years of 125,000, another 36,000, a little bit more than that actually total. Point being, we're close with the guarantees. So here we go. Let's take a look at the dividends here. So dividend rate, exact same thing, company A, based off of a higher crediting assumption. This is one of the major mutuals. And again, if you're in our membership program, you've seen this, videos on historical performance, actual policies that have lived the test of time, going as far back as 1970, 1980, and then policies that we put in force as a company, some that I put in force back in 2012, 2013, with the major mutuals tracking the original illustration, then the actual performance, and we see them delivering, which is great. That's exactly what we want. So we've got this here, dividend, 160,000 if we start at age 65, 210,000 per year if we start at 70. With this strategy on the right, it doesn't mean he may keep working till 70. The main thing though is if I have other assets, I may want to spend them down during this period of time or begin to liquidate them because those may be taxable, or I can let the tax-free bucket sit and grow for a little bit in order to be able to generate a greater amount of income. And while we are annuitizing this policy, we've got a level income stream. That's great. At the same time, we do not have to do that with a life insurance policy. An annuity product we would, where we just flip the income switch on and it spits income to us, whether that's monthly, annually, can be guaranteed, peace of mind product with an annuity. With a life insurance product, you can do the same thing. However, if someone said, okay, I pulled out 210,000 this year, I don't need that much next year. Maybe I only pull out 180. But then the following year, you know what? I know I'm in retirement, but this huge opportunity just popped up. I got to pull out 400K. Maybe I'll pay some of it back, but that's what I want to pull out. You can do that kind of stuff. You have complete control of the policy. Life insurance contract, it's yours. You're the policy owner. You've got control there. Then let's look at the indexed assumption here. 185,000 per year and then 250,000 per year. Now you're going to see a consistency, what we did in all of these. We can go a little bit more aggressive with these income runs. I don't like doing that though. Have you ever felt like you're shopping life insurance policies and it's all about what agent uses the company that shows the best numbers, the best income projections? When we're projecting very far out, we want to be careful of that approach. It's not bad to do it, to see the different options. I like to see everything up front too when I'm looking at any product. But it is very, very important or valuable to be aware of the fact that when we look at illustrations, that is a projection. When you look at reality, those projections almost never come true. Looking at policies that have actually delivered, looking at the guarantees first, set expectations properly. That way we know the product will actually work, as opposed to great looking numbers, doesn't pan out. Now it's like, okay, I banked on this happening, man. I don't got my money. We don't want that. So back to get on point here, left enough cash value in these policies, still have a death benefit too. We've pulled out significantly more than $3 million in all of these examples, guaranteed, dividend, and index. Let's look at the other two products here. So the L100, the traditional option here with company B, 164,000 per year based off of just the present dividend rate for 2021, which is 6%. And then if we start at 71, almost 212,000 per year. Same thing, leaving cash over. This one, a bit aggressive in my opinion. I would kick that down to 160, and then I would kick down to 205, just from a projection standpoint. Meaning I should have, because I ran these and put them together. All right, let's look at the last one that definitely has some potential long term. So here's that limited pay product, which again shows some fantastic numbers. Look at the income starting year 11, $194,000. Not an indexed product either. Dividend paying whole life insurance. Look at the deferred income, about $270,000 per year, all the way through. That is because of how the company is treating that product presently by holding some funds in escrow. So you do have the potential of hitting a home run, but full disclosure and everything, is that guaranteed to happen? Not by any means. So it's good to see it as an option. Maybe we split the policy. Maybe we put a portion of savings in that one and then a portion in the traditional product or the other company if we like that potential there, and it's still a strong product overall. Just options to provide there. So to kind of wrap up this case study and get back on the original point, it was an individual that wanted to see what? Income. That's how he came about the $300,000. He did not state, I want to pay in $300,000 per year. It was Steve telling me how much I would need to pay into the policy over the next 10 years so I can be where I want to be. I've got it mapped out. Here's what I want to hit in income per year. Show me what would be possible. And then if it is possible, let's pull the trigger. If it's not, let's look at some alternatives. Maybe I have to kick that down to 250. Maybe I got to kick it down to 100 and then set expectations realistic as far as how much I can pull out in income and such. But again, I'm looking at a product here. If you could see the same product on Amazon and play with a financial model that showed how much you could pay in, how much you could pull out, how much you could loan to take advantage of real estate purchases and such, pay off debt, whatever it might be, that would be ideal. Unfortunately, that doesn't exist yet. AI will get there probably sooner than we all think, but right now it doesn't exist. So we can certainly do that for you, or someone in the industry can. But overall, this again was the case study. I want this. How much do I need to pay in? And then here's what it accomplishes. Transferring my assets to fund it. I want the tax-free retirement income, core benefits of cash value life insurance. I do want to be able to purchase real estate, and the legacy planning long-term with that death benefit has value to me because I may not need all of that income every year. So hope you enjoyed this case study. I had a ton of fun with it. If you have any questions, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.